on the use of common stock as a source of finance. Last week, we dealt with the characteristics of common stock. And today, we will look at the advantages of using common stock only as a source of finance. We'll look at the advantages of using common stock only as a source of finance. The capital structure is mainly debt and equity. But some organizations prefer to use common stock alone. We know there are some advantages that they derive. It also carries some forms of disadvantages. So for today, we'll look at why a financial manager may prefer to use common stock alone, or what we call simple common stock structure. Simple common stock structure. That is using common stock alone as a source of fund. The advantages are the following. One, it protects the company's solvency. It protects the company's solvency. This is based on what we call self-sustenance theory. Self-sustenance theory, meaning that the firm is trying to sustain itself. Financing with common stock alone promotes the firm's solvency because holders themselves ordinarily have no legal rights to demand repayment from their companies. You know, it is permanent and long term. It's non-refundable. It's non-refundable. If it is debt, then you talk about being refundable and the interest being paid. But on common simple stock structure, you don't repay. Since you don't repay, there will be no claim made on it by outsiders in form of repayment of loan and interest, what we call interest and principal. So it maintains its own solvency. Cash repayments can only be obtained by selling the shares in the stock exchange. What do we mean by that? Any shareholder who is no longer interested in being a shareholder of that company or is cash strapped can only go to the stock exchange to sell off the shares to a new owner and then make use of his or her cash. The new owner continues to be a shareholder. The firm will not die because of the exchange. So that makes it a legal entity. That sustains it as a legal entity. The firm has no serious obligation to pay dividend. Even if it makes profit, it is under no serious obligation to pay dividends. We will examine the issue of dividend as we go along. Many public companies in Nigeria have not declared any dividend, okay, years after commencing operation, and no stockholder has gone to court because of that. Besides, all the assets purchased with common stock have no offsetting claims that must be paid, okay, that must be paid in as cash, as and when due. Interest must be paid even during bad times if debt is, or if the company commits itself to debt. So common stock finance will be obligations. Organizations that depend more on debt or debt finances suffers more during bad times, since both interest and maturing principals must be met, whether profits are made or not. This may force the organization into liquidation, and it may happen that little or nothing of the realized value of the disposed asset will be available for common stock holders. So firms prefer simple common stock structure because it helps them to protect solvency. It helps them to maintain solvency. It helps the organization to remain solvent because no one will ask them to pay interest or principal for debt. That is one very good reason why firms maintain simple common stock structure. The second reason is what we call the maintenance of good credit rating. Companies that are simple common stock financed maintain good credit rating. They have good credit rating in case they want to borrow, in case they want to buy on credit, in case they have anything to do with asset companies, even in form of credit rating. They are rated high because they use their fund, common stock, they use their fund to finance operation. In other words, this is the good debtor theory of common stock financing. We call it good debtor theory. They are good debtors because they have high percentage of common stock in their capital structure. They have high percentage of common stock in their capital structure. Companies that are predominantly common stock financed have a higher credit rating than those that have more debt. In other words, suppliers of raw materials, machinery and parts, suppliers of funds, especially banks, normally lend or allow credit after rating the organization. Creditors expect their corporate debtors to conserve enough cash in times of difficulties by not paying dividends, but meet interest payments and maturing principals as they become due. This is the good debtors theory. The good debtors theory. Firms that have predominant high percentage of common stock in their capital structure then can access debt, can access loan easily. Creditors would like to lend to them because they are good debtors. The ability of any company to borrow is a function of the amount of debt or debt funds in its capital structure, because the more the debt, the less the ability to borrow additional funds. When conditions are good, that is during economic boom, organizations that are more debt financed are in a better position to tap additional sources of funds and meet both short and long-term obligations because of increased profit figure. However, prospective creditors can be expected to have at the back of their minds that the firm would not be able to fulfill that obligation in terms of economic downturn. This is one of the major attractions of simple common stock structures. In terms of boom, they may suffer it, but in terms of economic downturn, they have a better advantage because no one will call them to pay any debts. The third advantage is what we call a reservation of financial capability. Reservation of financial capability. That is the third advantage. They have a reserve of financial capability. What are we saying? This is the best security theory. The best security theory. Organizations with simple common stock structures have a reservoir of additional financial capability than others that have complex structures. When we talk about complex structures, we talk about debt equity and various forms of debt, all right, including preference shares and the rest of them. In other words, they will be able to sell additional stocks at good prices. This is because prospective investors are well aware of the prior claims to assets by the holders. This expanded financial capability extends to periods of depression because they will still be better off, more favorably situated to undertake further financing if need be. Already, they are predominantly common stock financed. By chance they need additional fund, they will get it easily from lenders. They will get it easily from lenders. That is reservoir of additional expanded financial capabilities. Now, common stock finance companies have better prospects of selling debts or debt issues on attractive terms than companies of comparable size, scope of operation, and material competence than that have debts already in their capital structures. Investors will be interested in buying the bonds because of the safety of principal and interest. What do you mean by safety of interest and principal? It means that the company has not committed itself to any debt. It is predominantly common stock financed, so that any lender will have confidence that the company will be able to pay interest and principal as and when due. Equity provides a cushion for creditors if losses occur on dissolution. Equity provides a cushion for creditors if losses occur on dissolution. The equity to total debt asset ratio is an indicator of the degree by which the amount realized on the liquidation of assets may decline from stated book debt value before creditors suffer losses. That's an indicator. It could be calculated. Creditors normally calculate that so as to know the ability of the company or the capability of the borrowing firm to pay back interest and principals in case of losses. Proceeds from the bond issue may be used to finance expansion during depression, after which common stock will be sold to retire the bonds in good times, or the issue will be converted to ordinary shares if there's a provision for that, because we know we have convertible debentures, convertible debts. They're there. The next advantage is what we call Avoidance of restrictions on managerial actions. Avoidance of restrictions on managerial actions. Avoidance of restriction on managerial discretions. This is the management freedom theory. This is the management freedom theory. Debt issues carry with it certain terms, certain conditions and warranties, which directly or indirectly have inhibiting effects on managerial actions. For instance, if you borrow from a bank, a financial institution, to finance expansion, there might be a condition that you don't borrow again, or the assets so purchased will not be used as security for another borrowing. There may be a condition that certain investments will not be made, which may jeopardize the recovery of their loan. So these are called onerous restrictions. They form of warranties, conditions and terms, inhibiting effects on managerial actions. This might be in the form of protective covenants that buyers of security issues and lenders require to be included in their contracts. The provisions might cover limits on dividend payments. Limits. It may inhibit the company from paying dividends up to a certain amount. It may inhibit the increases in salaries and bonuses, sales of fixed assets, additional borrowings, mortgaging of assets, consolidations, mergers and acquisitions, maintenance of insurance covers, and other assets. These are the forms of covenants, terms, warranties, conditions that lenders might, like the borrowers, to comply with. With this situation in mind, management of any organization will not take any decisions without recourse to the contractual restrictions on assets from the investors, group lenders, or indenture trustees. Organizations with simple common stock structures do not go to this extent with their creditors. They are virtually free to undertake and implement any decision required to achieve the company's objectives. This is quite unlike the managers of companies with contractual limitations that will forego attractive courses of action because of apparent conflicts in the indenture, that is in the contract. The next advantage is what we call continuity theory. Continuity. Shares, common stocks are not repayable. Therefore, anyone that wants to sell off can go to the stock exchange and contract a new owner, meaning that the firm or the organization will continue. That is that is going to maintain what is called the legal entity concepts. Common stock has no maturity date. Therefore, holders can only accept to hold them in perpetuity or dispose of them to third parties in the market. This transaction does not affect the companies since it is only a change of ownership. The original investor obtains immediate cash for his proportion of ownership. Now, these are few advantages that companies that have simple common structures enjoy. Also, there are some disadvantages following them. If a firm contracts debt he pays interest. The interest is treated as a financial charge and it is tax deductible. It is tax deductible. If a firm contracts debt or has debts in its capital structure, it attracts fixed interest, fixed charges, and the fixed charges are treated as charges for doing business, expenses for doing business. Therefore, it is tax deductible. Interest is regarded as an expense for doing business by the government. This tends to enhance the profit of companies during economic prosperity. Therefore, it is very unreasonable and conservative to have equity as the only source of long-term funds. Opportunities to trade on equity is not utilized. That is, inclusion of fixed debts in the capital structure. The investment of equity holders provides protection for the creditors because they can seize the asset to satisfy their claims. The second disadvantage is the fact that common stock has high flotation costs than debt. Common stock has a high flotation costs than debt. It is relatively costlier to float common stock than to float debt. The expenses of selling absorb a greater proportion of the gross proceeds of common stock issues than of preferred stock. Also, preferred stock absorbs more than bond issues. Payments to investment bankers for their services in the marketing of the securities, especially if they are not underwritten, absorbs a considerable proportion of the proceeds, and difficulty in marketing increases if the shares are not underwritten. Other selling expenses include the taxes, the accountant's fees, registration fees, cost of printing and engraving, and so on and so forth. These are not applicable to debt issues. So common stock has greater costs on flotation than debt. The third disadvantage is dilution of claims to future profits. Dilution of claims to future profits. Additional sales of new issues may be made to obtain money for expansion. That is a situation where the firm needs additional funds for expansion. Instead of going to borrow, he may decide to issue additional shares. Issuing additional shares. However, if this is not done by way of rights, that is what we call right issues, stockholders may lose their competitive position with regard to the number of shares each investor holds. Some hold 30% of the shares of the company, some 5%, some 40% as the case may be. If the company there issues additional shares and it's not done by way of rights, meaning that the firm, the owner, the shareholders will lose their proportionate or percentage position. They lose that and it's not palatable. Rights that are not exercised have the same effects. Should additional shares be issued and sold and the original stockholders fail to subscribe, earning power will be transferred from them to the new buyers of the shares. Since stockholders do not like diluting their earning power, objections to additional issues may be raised unless it's done by way of right issues. No one wants to lose that. The fourth one is dilution of claims on assets. Just like dilution of claims to profit, it applies to dilution of claims to assets. Hence, that position or that percentage is lost. Then, the proportionate ownership or claims to assets is lost. The fifth one is danger of loss of control. We have also examined that because most debts carries onerous covenants in terms of terms, warranties, and so on and so forth. So the creditors may interfere with the management or the control of the organization. If the firm needs to add more funds and decide to issue new common stock, the original shareholders stand to lose their power of control if their rights are not exercised. The alteration in the relative ownership position causes a shift of power. This is because the degree of control that could be exercised is a function of the proportion of shares each person owns. The sixth disadvantage is that dividends are not tax deductible in Nigeria. They are not tax deductible. Dividends are not deductible for income tax purposes, unlike interest on debts, which is a tax deductible. We'll move a little further to examine the factors that affect the choice of common stock financing. If a financial manager decides to use simple common stock structure, which factors will he consider before making that choice? Which factors affect the choice of common stock financing? After that, we also look at the factors that favor the choice of common stock financing. The first factor we are going to look at is the profit size. The profit size. A going concern needs no debt capital if its profit size is large. A going concern needs no debt if its profit size is large. This is because it can make enough retention. It can plow back profits to finance the expansion programs. Without debt issues, controlling interests are not disturbed. Stockholders need not have fears about the dilution of claims to assets and profits. So if profit size is okay for a going concern, it may not need any debt. Again, we have to consider the age of the company. Most companies start as small businesses, usually as sole traders and partnerships. For several years after commencement of business, the predominant source of funds may be what? Shares, equity capital. This is because investors will not like to stake their savings on companies whose earning capacity is doubtful. If at all the company can get outside capital, it may be in the form of short-term loan and from other short-term sources. So if it is a young company, it is preferable for it to use equity. Then the next reason or the next factor is expansion requirements. Expansion requirements. If a company has a high and stable profit figure, it could afford to retain enough earnings to finance its expansion requirements. However, if the profit figure is so low that retention cannot finance expansion requirements, the company should consider obtaining additional finance from external sources, such as debt. Sometimes, the low profit figure may not warrant the sale of additional stock. That may also be a situation where a company desires slow but steady steady rate of expansion. In that case, simple common stock structure is preferable. If the profit is good, high and steady expansion could be carried out with retentions and perhaps sale of additional share. The situation, however, becomes very uncomfortable when the rate of expansion requires urgent attention in order to take advantage of increased sales or new cost savings technology. We look at stability of profits, not only the profit figure, but its stability. Stability of profits needs closer examination. This is because there's always a temptation to borrow additional funds when profit figures are high and stable. It is not a sign of financial prudence if the financial manager refuses to trade on equity when it has a stable profit, especially during the seasonal cycle. Therefore, if profit is stable, all things being equal, borrowing becomes very attractive. We have to look at government regulations. This applies to the limited extent of government intervention in the floating of debt by small and inexperienced companies. The Nigerian Securities and Exchange Commission controls the timing, the amount, and quantity of shares to be floated at each point in time. Therefore, if the regulations do not favor the circumstances of the particular firm, alternative methods of financing may be surveyed and exploited at that particular time. Arising is a market condition. Market condition pertains to the existence of buyers or willing investors to buy up the shares. At other times, companies may need immediate funds, and perhaps larger than the common stockholders will be able to provide given the economic condition and circumstances of the company. Under this situation, debt becomes the best option. Under this situation, debt becomes the best option. We finally want to look at the circumstances now that favor the use of common stock only as a source of fund. We want to look at the factors, the circumstances that favor the use of common stock only. One is where the firm's sales and profit figure fluctuate. Where the firm's sales and profit figure fluctuate, meaning that it's not stable. You're not sure of anything. If you go and borrow, you're not sure what the profit will come out to because the sales fluctuate. Remember, if you borrow, you must pay back interest and principal. So why it fluctuates, it's better for you as a financial manager to use equity. If the firm's profit margin does not cover the cost of debt, if it does not cover the cost of debt, then there's a problem. There's a problem. You better use ordinary shares. Profit margin do not cover the cost of debt. If the profit margin do not cover the cost of debt, are you going to use debt? No. If there's a situation where the firm has already a high debt ratio, in other words, it has in fact contracted enough debt, it is better to use equity, issue additional fund instead of debt. Another situation is where the firm is new and lacks access to debt financing. It's new, it has not operated for a long time, it lacks access to debt financing, then it has to use a common stock. Another situation is where control is not a problem. Where control is not a problem, you can use additional equity. where cash flow consideration is very important. If the relative cost of common stock financing is more favorable than debt, then one would prefer common stock financing. Where debt financing carries onerous loan agreement restrictions, we use equity. If investors see equity as a better hedge to inflation than debt or fixed income securities, then common stock financing is favorable. Common stock financing is favorable. What have we done? We have tried to look at common stock as a source of fund. We have looked at common stock as a source of fund. And we said that most firms use only common stock. They do not have debt in the capital structure. They do not have debt in the capital structure. They use only common stock. We looked at the advantages and the disadvantages of using only common stock as a source of finance for your business. It has advantages. It also has disadvantages. We have also surveyed the circumstances that may favor the use of common stock, predominantly common stock, as a source of financing. It may not be 100%, but at least it may be in the neighborhood of 80–90%. Yes. The next one we are going to look at is financing with rights. We have been mentioning right. What is right? Rights offering, financing with rights. What is right? Rights offering means the selling of additional common stock to existing stockholders. That's all. Selling of additional common stock to existing shareholders. In other words, the company is a going concern, is already listed, shareholders are in existence, it needs additional fund. Instead of selling it to new owners, to new investors, it will first of all give it as a right to those who are already holding the shares of the company. That is financing with rights. It also has its advantages and disadvantages. Financing with rights. So this is the second long-term source of fund that you will study. Before a firm can use this source, its shares must already be in the market. Before a firm can use this source, its share must already be in the market. That is why it said selling of additional shares to existing shareholders. The shares are already in the market. Okay? The idea is that since they already hold the shares, they would like to buy additional shares to add to the ones they are holding. This will add to their income. This will help to maintain their proportionate ownership position. This will help them to have the same controlling shares in the ownership. Perhaps it will attract low expenses for the company since the costs and inconveniences following flotations are avoided. Instead of going through investment bankers and the rest of them at that level, you can sell to existing shareholders, avoid the costs of flotation and the inconveniences. Therefore, this method is recommended as a good source of fund. And this will only be the case if the company shares are already listed and it wishes to raise an additional capital, which is moderate in relation to the amount already issued. The condition is that the company shares are already listed and it wishes to raise additional capital, which is moderate in relation to the amount already issued. 2, the current market price of each shares is about the nominal value. If, for instance, you issue the original one at 50 kobo per share, and the current market price is 70 kobo per share. In other words, the current market price is more than the par value of the shares. In that case, those who are already existing shareholders will have to buy additional shares. They will have to buy additional shares to maintain their proportion, to maintain their position, and also have a gain. I said the current market price of the shares is above the nominal value. 3, the corporate charters requires that a new issue of common shares or an issue of convertible debentures be offered to their existing shareholders before they are made available to third parties. Before they are made available to third parties. This process may or may not require the assistance of an issuing house. Firms prefer this because of the strong belief that the common stockholders constitute the best market. Those that are existing shareholders constitute the best market. The very fact that investors have already bought and continue to hold the company's common stock is a strong indication that they will be interested in buying additional issues.
Hello, sir. Good evening, sir.
We want to look at a tab, preemptive rights.
Hello, sir.
Rights. You may be hearing of preemptive rights. Under this agreement, existing shareholders have the right to preserve their proportionate ownership in the company. Thus, if the company floats additional stock, the existing shareholders must be given rights to subscribe to the additional shares in order to maintain their relative position or pro rata interest in the company. If a shareholder holds about 5% shares in a company, he must be given the right to subscribe to 5% shares of the 5% of the new shares. This is known as a rights issue, or shareholders are said to obtain the shares by privileged subscription. Shareholders are said to obtain the new shares through privileged subscription. Preemptive rights. Preemptive rights. Privileged subscription. We want to look at the scope and procedure of rights offering.
Hello, sir.
We want to look at
Hello.
the scope and
Can you hear me,
procedure
sir?
for rights offering. Rights offering are feasible if the company has a proportion of unsubscribed shares capital. If the authorized share capital is 50 million, you have already issued 30 million, remaining 20 million. You now can issue this 20 million by way of rights. So, rights offerings are feasible if the company has a proportion of if unissued share capital. If this is the case, the board of directors will adopt a resolution to set out the terms and conditions of the offering. The resolution will state, among other things, 1, total number of shares to be offered. The resolution must state the total number of shares to be offered. The resolution must state the price per share. The price per share must be stated. 3. The record date. Please pick this term. The record date. At the close of business, on which the names of stockholders entitled to buy will be determined. That date is called